Rohit Singhania, who is the Co-Head of Equities at DSP and manages a couple of our funds. Rohit, very happy and delighted to host you today. And what exactly is your investment framework? Could you just run us up in 2 minutes?
Thank you, Ankita, for having me here. I think when you look at investment frameworks is, how as a fund manager do I analyze companies? What goes into understanding those companies and how I get them into the portfolio. So if you want it in simple words is, I like companies, I like buying companies, typically, growth at a fair valuation. Everyone looks at business cycles, business qualities, the management of the company, how the balance sheet is, right? That is a key ingredient for every framework. But what on top of it, I try to do separately is have something like a margin of safety. So if you're buying something, what are you paying for it? Is it worth that? Can the value increase or you're paying a top value? So usually I don't like paying top value for anything. And there has to be a margin of safety at what price I'm buying the stock and what returns it can give me over the next 1, 2, 3 years. That's one. In addition, when we talk about business cycle, what is the business mode? Take, for example, an auto company. So what segments is an auto company prevailing today? What are the competition doing? What is the outlook for that particular segment? So just because you're an auto company, it's not everything doesn't fall into one basket. You have to break it down into segment wise. That's how the analysis is done. Then you look at the management. What's been the history of management? What they have done during bad cycles, good cycles, what their behavior has been. So that gives you some sense, right? If things go wrong in the future, how they may act or react. Third is, in the end, what are you paying for it? Is there a margin of safety? And when I say margin of safety means at what value are you buying the company today? And how do you compare the value? What was the company trading at last 5 years averages, 10 years averages? What was the sector trading at those averages? So if you find comfort in all these three, you go and buy ahead. So I would say again to reiterate, buying growth at a price and keeping margin of safety. That is the core of my framework.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.